time, and I'm not going to take away their time. You can read the bios in the back, so I'll just quickly introduce them and then try to hold them to 20 minutes each, so that we'll have plenty of time for questions, because I imagine there will be a lot of questions about the outlook of both our economy and the global economy. So our first speaker is Lakshman Achuthan, who's been here. He just told me. I knew it was for many, many years, 15 years he's been coming. He will go first. Philip Suttle from Suttle Economics. And we share a mutual friend, Warren Mosler. And Michalis Nikiforos, who's a colleague of the company. So, thank you. Thanks. Right on.
Wray. Hi, everybody. Thanks, as always, for the Institute putting on this conference. It's a great time to kind of step back and look at the big picture, which is, I think, super important. So I'm glad you're all here. So, given ECRI's focus, the Economic Cycle Research Institute's focus on economic cycles, we have a pretty solid read, we think, on where we are in the business cycle. And when we then strip out the cyclical, what's left is largely structural, which helps us distinguish between economic developments that are cyclical and structural. And so that's what I wanted to speak with you about today. Last year, I made the point. Can everybody hear me okay? No? No? Okay, get a little closer. Is that better?
Yes.
Last year, I made the point that people often conflate the two, cyclical and structural. And last year, given ECRI's optimism about cyclical growth prospects, a lot of conflating was pretty sure to come down the pike. And now that we've had a few quarters of synchronized growth and inflation moving a bit higher, we're seeing the impact of those developments on the mood of policymakers, and it's palpable. It's a pretty significant impact. By the middle of last year, just to keep track of this, the world's central bankers were increasingly convinced that we had turned a corner in a structural sense. Emerging from their group meeting in Sintra, Portugal, they all sounded more hawkish, or at least less dovish. And this was the beginning of a kind of mission accomplished moment, and at least implicitly suggesting that an era of low trend growth and lowflation was drawing to an end. And their confidence kept rising. The latest Fed minutes that we recently got a look at show the FOMC was unanimous that the outlook for the economy had strengthened, that inflation would keep rising, and that now fiscal policy would boost the economy even more than previously thought over the next few years. So again, it sounds like they believe in a structural shift away from low trend growth and lowflation. So let's dig into the evidence, and starting with this chart that I highlighted, highlighting a structural downshift in growth that ECRI identified, actually it's now a decade ago. So first, before the chart, let me give, if you think about the economy outside your window, what is it? What's it all about? It's about output and jobs and income and sales. And that's precisely what goes into the U.S. Coincident Index. So that's how we capture the economy outside your window, and that's the U.S. Coincident Index, or USCI. So in August of 2008, before Lehman blew up, we saw this long-term decline in USCI growth during successive expansions going back to the 1970s. So this is the pace of growth from trough to peak in the economy in the U.S. Coincident Index, and all these expansions going back decades. And so it seems pretty obvious looking at the chart that there was a slowdown. There's been a slowdown in the pace of growth during expansions. But apparently nobody had looked at it this way, including us. I mean, we hadn't seen it either until 2008. And so we're pretty late, quote unquote late, in seeing that, which had obviously started in retrospect much earlier. But we were pretty prescient relative to the consensus, which was looking at other stuff. And I think the consensus view started to come on board, it's a little less than 5 years ago, following Larry Summers' 2013 speech about secular stagnation that seemed to kind of echo what this chart shows. However, ECRI never bought into that particular diagnosis with all of its potential implications. Rather, for a decade, we've been talking about something very specific. This long-term structural decline in trend growth. So let's revisit the basic building blocks of growth, namely productivity growth and labor force growth. And this chart is something I showed quickly last year, and I've updated it for you today. The bottom blue line shows potential labor force growth, and the Congressional Budget Office projects that this will average around 0.5% a year for the next 6 years, and I've just laid over their estimate, which is pretty much on the top of the blue line there, with the red line. Now, labor force growth is pretty much set in stone, given demographics, and unless immigration is cut, because immigration accounts for about 2/3 of their estimate, legal immigration. The top green line is productivity growth, and the 6-year average I'd shown last year was about 0.5% a year. That's the red line, horizontal line, and that's pretty far below its post-World War II through 2008 average of 2.25%. Now, we have 4 new quarters of data, and so you can see a little bit of pop in productivity growth over those few quarters. Now, to my eye, and it's already ticking down a little bit, to my eye, I'd be hard-pressed to call that pop a structural breakout in productivity growth. And so the math is basically straightforward. You get 0.5% labor force growth, 0.5% productivity growth, and that gets you to around 1% longer-term real GDP growth. And I totally get that that is not what any of us want to hear. I agree with you on this, right? I don't want to hear this either. But demographics are what they are. So necessarily the pushback has to be productivity growth. It is, or soon will be, much higher, right? Now, as a student of the business cycle, again, it's hard to argue for me, just looking at cycles and stuff, that pop at the end is a structural breakout in productivity growth. And I get it that people are going to disagree and say that we're on the verge of something better or we're measuring it wrong. So I'm just going to quote, I'm going to rely on The Economist magazine, which very conveniently, just in the latest issue, said, and I quote, "Economists understand even less about economic growth than about business cycles." So I'm going to put it to that. So all right, let's move on to see that what ails the U.S. ails pretty much everybody. Now this chart is using similar data as the previous chart, and it shows the simple math of adding up productivity growth and labor force growth for the G7 economies. The starting coordinate for each country is the 1957 to 2007 average of productivity growth and labor force growth. So for the United States, for example, that's the starting point. And it's above, it adds up to more than 3%. So that's the starting point right there. 1957 to 2007 average. The ending coordinates near the arrowheads mark the average productivity growth for the past 6 years, not forecasting it, and potential labor force growth for the next 6 years, relying on the CBO estimate. And so you see, based on the combination of that, we get potential long-term trend growth for the U.S. at around 1%, which is what the earlier chart had suggested. The key here in these charts are these slanting lines. Okay, and we're going to focus on 0 to 1%. The horizontal and vertical coordinates, which is labor force growth and productivity growth, add up to 1% on every point on this 1% diagonal line, or to 0 on every point on the 0 diagonal line. That's the potential GDP growth given this simple math. And just for some reference, for you history buffs, I won't put you as far back as you just were earlier in the 20s, but this X is, that represents Japan's lost decades. So it's from 1992, when the post-bubble recession took hold, to the eve of the financial crisis. And you see, that's where they were, and all the major economies, this is a G7, are headed for worse potential growth outcomes. So what about emerging markets, okay? Maybe they'll help us out here, right? So here is the equivalent chart for the BRICS. The same productivity data is not available, so we're substituting GDP per person employed as a proxy. GDP per person employed as a proxy for productivity. And the starting coordinate for each country now is 1991 through 2007. That's the average starting points here. And so you see Brazil and Russia are having a tough time. They are actually, their potential GDP growth is around 0, just a little above or at 0. China and India have much better prospects. But even China's losing altitude. It's going from 10.5% potential GDP down to 6.5% as labor force is really declining. It's actually going negative. Here's the 0 line. Labor force growth is going negative, and productivity growth is also falling. Potential labor force growth for India is also falling. It's going the wrong way. Right? It's getting less, but their productivity growth goes up a little bit. So they managed to eke out, in this estimate, 6.5% potential growth, the same as China. A lot better than everybody else, but easy potential. So taking all of this information together, the earlier slide for the G7 and this slide for the BRICS, it's evident that structurally the world's growth potential is downshifting. Has downshifted, is downshifting. Yet again, the prevailing wisdom is that we may be seeing a structural shift away from low trend growth and low inflation, and that the U.S. is leading the way, right? We're in the front of the line here. And I believe that this is because people are confusing a cyclical upturn with a structural upshift. So let's take a look at that U.S. coincident index I mentioned earlier. The shaded areas, and this is zooming in from 2006. So the shaded areas here mark off decelerations in coincident index growth, or what we call growth rate cycle downturns. And the Great Recession's really easy to see, right? But following the recovery from that recession, please note the 3 cyclical slowdowns. You have in 2010-11, so it's 2010-11, 2012, 13, and 2014 into 16. Following which there was a cyclical upswing, the white area, from mid-2016 began through late 2017. So that, and that recovery in growth, which you see there, has actually eased in the last few months. So put another way, this chart shows that the post-recession growth rate cycles, it shows them, but it's hard to ascertain from this chart any sort of structural upshift that has been taking hold, supposedly. Still, after a year or so of this cyclical upswing in growth that I'm showing you, many are talking about the end of secular stagnation or the normalization, that word is back, of the economy and interest rates. Now, I don't know about you, but to me, the lack of evidence of a secular shift, from this chart at least, is pretty clear. So turning from cycles in growth, which is one aspect of this issue, to inflation, what's going on there? So much has been made of year-over-year headline CPI inflation turning up and rising from 1.6% last June to 2.25% to 2.4% in March. And now that's getting it within striking distance of 2.8%, which would be the highest we've seen in 6 years. So let's unpack that a little bit. Looking at the details of the upturn in inflation, so you have the shaded areas are inflation cycle downturns. What we see is that it's largely driven by a spike in food and energy growth. You see that right there. And that began in mid-2017, that surge there. Now, core CPI troughed late last summer, and here on this chart, I'm just splitting it into two, so you can see goods and services core CPI inflation, and we can see what's going on. Core services inflation on the top, after increasing only marginally since mid-2015, has ticked up a bit at the end there. But even this modest upswing actually isn't that broad-based. And then in the early fall, core goods inflation turned up. This is the gray line here. It's below 0. And that's turned up. But it's been consistently negative since 2013. Despite, as you'll hear, all the unprecedented monetary accommodation from the Fed. So if structural lowflation is to draw to a close, this persistent goods deflation, core goods deflation, must also start winding down. So from this chart, I find it hard to argue that we're clearly seeing the structural upshift away from the lowflation that we've been talking about for some time. Now, from our vantage point, again, we're looking at cycles. So in our leading indicators, we saw this kind of stuff coming. So here we are back in the summer of 2016 with a global reflation call based on the leading indicators. And this is occurring in late summer of 16 when inflation expectations had actually taken a nosedive. But these cyclical leading indicators were looking the other way. It's purely based on cyclical leading indicators. Later in 16, we made a US growth rate cycle upturn call based on leading indicators of economic growth. And in fact, these US indexes were turning up in sync with our leading indexes of global economic growth, which we highlighted in October. Now, let's recall a couple of things, because it's ancient history also, October 16. Of course, it was before the presidential election. And that same month, the IMF cut its global growth forecast across the board. This is when that Greek forecast a cyclical upturn in global growth. In particular, we noted that growth in the majority of our long leading indexes for the G7, which we looked at earlier on the structural chart, have now climbed above their year-ago readings. They were starting to move. And if you fast forward to February of 17, several months later, it's hard to remember this, but the popular refrain was that the hard data were not confirming the strength in the soft data. If you go back, that's all the headlines. This is when we flagged the brightest global growth outlook since 2010, because growth in our 20-country long leading index was at an 80-month high. That's that little bottom chart there. That's an 80-month high. So directionally, it's super clear. In the months that followed, the consensus caught up and the optimism about global growth began surging. And on cue, having recognized the reality in the rearview mirror, the IMF has been upgrading its forecast. But the point remains that the now kind of famous, everybody's on board for the global synchronized growth upturn, it was cyclical. It was predicted based on cyclical leading indicators. And that was after leading indicators of inflation had shown a cyclical reflation. So where's the structural shift? How do we see a structural change? What can you get there? And I mentioned earlier, because we're so focused on stuff that is cyclical, it allows us to maybe tease out some things that aren't, and that otherwise may be structural in nature. And with growth and inflation, we just don't see a structural shift. It's explained all by cyclical factors. But in other areas, structural shifts are apparent. Now, Donald Trump wrote to the White House in part on the promise of an economic revival at home, largely by reversing the massive deficits piling up between the U.S. and its trading partners, and China was chief among the list. Since then, this imbalance has increased, and the trends in three key sectors of trade are revealing. The chart shows U.S. trade surplus and services on the top, along with trade deficits in petroleum and non-petroleum goods on the bottom. Since 2010, the U.S. trade surplus and services has virtually doubled. Meanwhile, the petroleum goods trade deficit has shrunk this decade to around the lowest level in a century, or this century. But the improvement has been totally swamped by a staggering expansion in non-petroleum trade. Deficit to a record high, and that's nearly tripled since 2010 and accelerated in the past year. Indeed, both China and Mexico, with both China and Mexico, the non-petroleum goods trade deficit has never been higher over any 12-month period in history. So these patterns aren't fully explained by cyclical forces, and in large measure may be structural. But then you've heard a lot about globalization as being part of the culprit for this stuff. So I want to give you a quick look there. It has both structural and cyclical components. Now, our measure of globalization is the difference between the growth rates of world trade and GDP, because globalization implies faster growth in trade than GDP. So this measure experiences cyclical swings associated with cycles in global growth, because during an upturn in growth, international trade tends to grow faster than global GDP, while the opposite is true during a downturn. Now, separately, structural globalization becomes evident when the measure is substantially positive for an extended period of time, which you see here. And this is what happened when we had this, what we call the globalization tsunami, hitting the world economy between the beginning of the 21st century and the financial crisis, where you had that persistent time positive growth here. Now, following the financial crisis is interesting. You see the structural retreat of globalization. And that's pretty evident, because this measure is staying negative all the way through 2016. Now, it did edge above. Some of you sharp-eyed people will see that it's edged above there, above zero in 2017, but it's already ticking down. And so, what's going on? We think it's part of a global slowdown, actually. Here's a leading index of global growth, shown at the top. It's very prescient about cyclical turns in global growth. It correctly anticipated the rise that you see. So this run up here is consistent with this cyclical rise. Now we have the decline, so this looks like it's going to ease back down below zero. That doesn't seem like much of a stretch. And meanwhile, even though year-over-year global GDP growth is still rising, it's a fact, it's begun to flatten out and should roll over in coming months. And you can start to see the global growth downturn in the rearview mirror when you look at quarter-over-quarter annualized GDP growth for the US, the Eurozone, and Japan. In all three, GDP growth peaked in the second or third quarter of 2017 and fell in the fourth quarter. This is what the start of a synchronized global growth downswing looks like. And all of this suggests that the consensus is playing catch-up on the cyclical outlook. And you have international central banks concerned about overheating that are even further behind, I think, where they're mistaking last year's cyclical upturn for something more sustained and perhaps structural, shifting towards a more normal economy. And of course, hawkish shifts in the face of economic slowdowns that policymakers don't see rarely turn out well. So, in sum, 1 minute, I'll be done. We have a long-term decline in trend growth that's intact. We have ups and downs in the economy, including the recent synchronized global growth upturn that are explained by cyclical factors. And we do have structural shifts, and they concern the composition of U.S. trade and the end of globalization. So it is true. I mean, people are feeling stuff, right, around outside of this room, The globalization tsunami that arrived early this century left many people high and dry in the advanced economies. But that globalization tide has been receding since the financial crisis ended. Now, we do have a relative decline in the Western economies relative to the East, and I discussed that last year, but it's not being driven by globalization. The long-term decline in advanced economy trend growth is being driven by demographics plus this problem with productivity growth. And that isn't over, despite what we might hope for. But when the mistaken belief that it is over drives policy, in particular, we're looking at cycles, the timing of the big shift from quantitative easing to quantitative tightening on a global scale. Monetary policy is going on a collision course with the economic cycle. And so, given what you see right now, if we stay on this course, if things don't change, that will raise the risk of a new recession. So we have to keep an eye out for that, I'm afraid. Thank you very much.
Good morning, and that's going to be a hard act to follow. I mean, it's always a challenge because we economists tend to think alike and have many of the same charts. So what I'm going to try and do actually is kind of tease out in my presentation where I might be slightly different from Lakshman, although unfortunately, because we're economists, we tend to think alike and there'll be a lot of overlap. I would also say I thought Jan's talk was very interesting. One point I thought you were going to make, which came to my mind as you were speaking about Warren Harding and drawing the parallels with Donald J. Trump, is that Harding's, at least in my memory, quite famous for being our first American president who fell in love with golf. And actually, he was quite a good golfer, apparently, and clearly and was widely accused of spending way too much time on the links, so there's another parallel there. But I just want to spend some time, if that's okay, running through, kind of organising my thoughts around four basic topics, without dwelling too much. Where are we in the global cycle? Where are we headed? Talk a little bit about the inflation outlook and give you some of my thoughts on that. And that's possibly where we've got some differences, but I'm not 100% sure. Where are we in the monetary policy outlook? Again, I don't think any differences. It's just, I guess I'm less. What's the right word? I have less of a view on what should happen, more on a view of what is going to happen. If you see what I mean, I'm not giving gold stars for good behaviour. I'm pretty sure things will get screwed up, but let's focus on sort of how that might happen. And then, kind of related to the screw-up theory of the world, spend a bit of time dwelling on how I see the financial system still, frankly, very risky. And I mean, as is always the case, the crisis that we're going to have at some point in the next 3 years, let's say, is going to be very different from the ones we've had in the previous downturns, because that's just the way the world works. We always fix the last problem, and in so doing, very often create the next one. So where are we in the business cycle? Not as elegant a presentation as Lakshman just gave, but I mean, actually, the bottom line is we're late cycle. Globally, we are late cycle. We're actually, I've taken the liberty of just putting in a little kind of red line there with my Q1 forecasts for global growth. And they're actually quite negative or quite pessimistic relative to consensus, because although the US, I think it's widely accepted, had a poor first quarter, I'm not so sure people realise how weak Europe and especially Japan was in the first quarter. So if you put my numbers in and willing to take those, we're now essentially in the midst of the fourth, I think we line up our thinking, we're in the midst of the fourth mini down cycle of this expansion. Actually, the fourth is usually the last one as we go back through G7 cycles. There is one exception, which was the 1960s, when we had 5 ups and downs within the business cycle, and we're probably into that type of scenario, a more extended expansion. But notice on the right-hand side, I've put up, if you're willing to believe them, unemployment rate charts across the world. And what I find striking is in most countries, the current level of unemployment is actually below previous cyclical lows. There are a few exceptions, most obviously in Europe and Brazil, where in Europe the 2012-13 recession took its toll, and in Brazil it was more recent. And in fact, those recessions are emblematic of why we had these mini cycle downturns, because the second one was Europe, and the third one was the emerging market commodities correction, which Brazil was very much the leading edge of. Taking a slightly shorter term view, I think a couple of points are worth highlighting here. One is, if you look at the last few years, the story's really been one of growth convergence. The expansion has really been all about a secular slowdown in the emerging world as much as it is in the developed market world, and that's been led by China. And in the last few years, we've actually seen a net acceleration in developed market growth, although, as we've been pointing out, that's now beginning to roll over. And I think what is most important to note is that when you look at that right-hand picture, I like to look at these things called surprise indices. Every bank and a few institutions, I'm not sure about ECRI, calculates them, and they often kind of look a little different, but in general they capture the same spirit, which I think of as actually a very good way of thinking about economic momentum, because you're not just looking at pure momentum, you're looking at the component which is catching people by surprise. So actually when it's up, it's a real sort of signal that things are going better, and when it's going down, it's a pretty clear signal that things are getting worse. And I think what I find very striking is that the surprise indices for the US have deteriorated relative to where they were in the fall of last year, but they're not anywhere near as weak as those coming out of Europe and Japan, and that goes back to the earlier point I made. And in fact, you could argue that the surprise data are kind of one of these classes of soft data, and now what we're looking at here in this slide are genuine hard data, which are on the left-hand side, consumer spending, retail sales numbers aggregated for the G4, which is US, Europe, Japan and the UK. And on the right-hand side, the IP numbers, the manufacturing output numbers for essentially a similar group of countries. By the way, I just checked the US number there that's a dotted. These are quarterly data, so the dotted line is a forecast with March data put in for each country. We literally about 10 minutes ago got the US data for March, and it's very much in line with what that dotted line says. So the grey, is it grey for the US? No, sorry, blue for the US. The blue line is facts now. But when we get in the next month or so the March data for Japan and Europe, it really will look as, I can guarantee, it really will look as weak as those data points suggest. And coming back to the left-hand side, I think it's fair to say that the surprise has been how weak global consumption has been over the last few months. I look at it in the context of you need to smooth the data, because that burst of growth in the middle of last year, in retrospect, when everyone was getting very upbeat, was kind of an extreme outlier on the high side, and we need to smooth it. In fact, one of the supreme ironies, I'm originally from the UK, and one of the supreme ironies is that in the UK, they have Black Friday shopping. It's a huge shopping event in the UK, and we don't have Thanksgiving, but we have the post-Thanksgiving thing. I know, that's the sort of thing that can throw these things around. So that's where we are, and I think we're sort of broadly in agreement. I don't look at it as, oh my God, we're in for another downturn. It's, growth cycles come and go, and here we are on par for the fourth mini cycle downturn. Where are we headed next? Well, maybe I'm a smidgen more optimistic here, because it seems to me that the stance of policy is still quite supportive of growth. I look on the left-hand side at monetary policy, modest tightening underway in the developed market economies. net easing has been significant in the emerging market economies. And when you've got what I characterize as a 50-50 world, the demand side of the global economy is 50% developed market consumers, probably a bit more now, 50% emerging market consumers. That easing in the emerging world actually is quite important to supporting global growth. But on the fiscal side, you see, I think, two important points from these right-hand charts. One is, these are just simple kind of Keynesian-style fiscal thrust measures, changes in cyclically adjusted budget balances for the major economies. And in the top one is showing the US, and in the bottom, non-US. And I think what they show is kind of as you go through this whole expansion, we saw this very early counter-cyclical fiscal policy put into place, ridiculously tight early on in the expansion, which is one reason why we've had such a weak expansion. So there's a kind of similarity in the pattern of fiscal policy across the major countries until this year. And this year we have, I've forgotten how the Fed minutes the other day characterized it, but they said something like, we've never seen such an unusual expansion of fiscal policy at this current point in the business cycle. They were very delicate about it, but essentially we're seeing a very reckless fiscal policy experiment being undertaken, whereas in the rest of the world it's more traditional. And the way I would think about that is what it means is that there is a pretty good chance over the next 6 to 9 months, which is as far as I feel I can see, that US growth will outperform. Not necessarily the rest of the world, because the emerging market world may do okay because of the supportive monetary environment, but certainly outperform the rest of the developed market economies. And it kind of raises interesting questions about the dollar, because if you'd have given me this information set 6 months ago and said, tell me what's going to happen to the dollar, I would say, yeah, it's going to be stronger. And it hasn't been. And we can all talk about why that is so, but to me that's a little bit of a tension that's out there. The other thing I'd highlight looking ahead, and maybe this is where we've got some slight divergence in thinking, is I actually think the private sector is pretty well supported to support growth here, wherever you look. Now, you could actually argue that's part of the problem, because although the private business sector is well supported, is well positioned to support growth, it's not doing it. And I think it comes back to this idea, which maybe we'll talk about a lot in the next day or so, is why are we just not seeing enough investment? The missing link in global growth is a lack of investment, whether it's public sector or private sector. And I think it very much speaks to this idea as to why productivity growth has been so disappointing. I'm not a big enough thinker to get into the whole idea of how you drive total factor productivity, but I do know that most measures of productivity are fundamentally driven by capital spending. And we've had a lack of it in this expansion. Now, if you look at the right-hand side picture here, I show, I think someone's going to suggest these data are flawed. I think you said, there's a problem with these data, and I fully accept there might be. But I'm looking at the Fed's flow of funds data here, and looking at the financing gap of the corporate sector. And at least historically, it's been a very good cyclical indicator, so that when companies go crazy and start borrowing a lot of money and investing, you're late cycle, and the financing gap is high, the financing requirement is high. The picture tells the story. We're close to historic lows on the financing gap. So I view that as a lot of potential for the corporate sector to still contribute. Whether they will or not is another matter. And on the left-hand side, I just illustrate a somewhat simpler picture, which is Japan, giving you an example of how robust the corporate sector is there, how profitable it is there. Okay, so looking ahead on growth, I'm probably a little more optimistic, but fully accepting that we are in a current little downturn phase. On the inflation outlook, again, maybe there's some slight differences here, because I actually think we are in a late cycle uptick in inflation environment, and I think the data are beginning to support that. My only point is I think we need to think about inflation as a lot more complicated than most economists do. I characterize my career as a career when I came out of college, everyone thought inflation was driven by the money supply. And now everyone thinks it's driven by slack, whatever that is. And we can't measure either of those things competently, but we're still highly confident that this single variable drives inflation. We would never think about growth that way. You know, if I said what drives the growth environment, you'd say, well, there's kind of 15, 20 factors that I need to put into my right-hand side equation. And I don't see why we shouldn't think that way about inflation. So I think of inflation anywhere as the overlay of a set of factors. And for example, in the US, what we're clearly seeing, top right picture there, is a material pickup. Maybe Lakshman's going to disagree, but a material pickup in goods pricing. I'm not 100% sure why that's happening, and it may not last, but it's been very noticeable. And, you know, one argument there is weak goods pricing was the result of what you might call an Amazon effect, and that's beginning to disappear. That's beginning to fade. It's the compression of retail margins has reached a point where they can only begin to rebound. The other obvious point is protectionism. You know, markets are beginning to price in more protected markets. There's more pricing power in goods. Now, having said that, the service sector, if you look at the bottom right there, I mean, we've seen rents roll over. And that's actually quite a standard phenomenon. Late business cycle, rent price inflation often moderates because the housing supply comes on stream. And in this context, we've seen a pretty significant overbuilding in apartments. And that's beginning to put some downward pressure on rents. So kind of very counterintuitive that late cycle we can get moderation in some of these service components. But I would say sort of put it all together, package it all together, I think we're in a higher inflation environment, at least in the US. Takes me to the monetary side of the picture, monetary policy. And I just think that we're in that late cycle tightening environment led by the Fed, followed by the Bank of Canada, followed by the Bank of England, followed possibly by the RBA, very reluctantly later on by the Europeans. So it's a kind of sequencing process that I think we can all agree remains very, very gradual. You know, if you go back to the chart I showed earlier about level of rates, you know, the uptick we're seeing in the current environment and where we're probably going to be in a year or two's time comes nowhere near the peak of rates in the 2010 cycle, let alone 2006, 2007. So we are still talking about an accommodative overall stance, but nonetheless, one that I think does warrant higher nominal rates. The Fed's probably going to 3 at some point over the next 18 months, 2 years. But I think, and in some sense, the interest rate environment, the market's kind of priced to that. So the interest rate environment, I don't think is that worrying. Where I think we probably have some agreement, and I'm a little nervous, is how blasé everyone is about the wind down of QE. I'm very suspicious about economists who one leg of the business cycle tell one story, and the other leg tell the other. So on the way into QE, it was all about the flows matter. Now, as we begin to exit it, it's the stocks. Now, you guys are much more into stocks and flows than I am, but it seems to me that both matter and both are relevant. And at some point, there's going to be a kind of moment where the market wakes up and says, hey, hang on, this withdrawal of support for risky assets by central banks does begin to matter. Which takes me to my last point. I hope am I still in? 3 minutes, okay, great. Takes me to my last point. This is a huge topic, so I'm going to very much, just barely touch on it, which is, is the system safer, or perhaps more to the point, where is it not safe? And I think the way I would look at the current situation is we've had 10 years of financial repression. I don't mean that as a value judgment. I'm not saying it's been a bad thing or a good thing, but we have had 10 years of financial repression. And we're beginning to see the unwind of that. And I think when you begin to see the unwind of financial repression, you can have all sorts of debt difficulties that emerge. And I'm not picking on Sweden here, but Sweden's a great example of a close to fully employed economy with robust growth, with inflation at target, and interest rates at -0.5. Now, I mean, does anyone in this room think that's a sensible combination? Maybe you do, but I certainly think it is not. And the only issue is, when does Sweden have problems, not does Sweden have problems. And they're going to come through the debt market. And the great thing about Sweden, I first started doing macroeconomics in the marketplace in the late 80s, and Sweden was the country I first studied, and it blew up dramatically. 20 years later it blew up again dramatically. So it's kind of got a track record. So sorry if anyone from Sweden, I'm picking on you. But the good news is, sins can be generalised, and I think what to me is fascinating about the next 5 to 10 years is we face an environment where the debt problem could well occur in the market that we think of as the safest asset, the US Treasury market. What I've done here is I've shown the US budget deficit on the right hand side, where you can see there's a kink in the dotted line. Actually, up until that kink is quasi-fact. It's where we're probably going to be over the next 2 years. What I then did was I added a recession to it. And I didn't add a severe recession, I just added the average budget deficit deterioration over the last 3 downturns. So you're throwing in 08, 09, but it also includes a couple of much milder downturns. And you can see that we could easily get to 10 or 11% of GDP in an environment where, without that happening, we're already going to 100% of GDP on the federal debt. So I leave it to your imagination as to how that might play out, but that certainly worries me. So to conclude, and I'll let you, maybe your eyes go over some of these points, but in a sense, my basic thesis is things look good, things look great. In fact, I've got these kind of, has anyone seen the movie Get Me Roger Stone? If you don't, you should see it. It's a fascinating movie about this character, Roger Stone. And Roger Stone has these things called Stone's rules, which are these political mantras. And I suppose I have Suttle's rules. And one of Suttle's rules is the world economy is always doing better than people think it is. People just generally are very bad at perceiving that things are quite good. And I would say global economy is in very good, healthy shape. We're at full employment. I mean, we have the mantra of what we were all dreaming of in the 70s and 80s, which is full employment and no inflation. And we think it's terrible. Now, there are reasons for that perhaps, but it's good. But the reasons why I would say you need to condition that optimism of growth is there are a series of negatives. And, I won't go through them one by one, but many of them, we've talked about, Lakshman or myself already talked about, and I'm sure there'll also be themes that we'll talk about in the rest of the conference. So, thank you for your attention, and it's time to move on.
Good morning. I would like to present a paper that a policy report that we recently published, and you can find some copies in the back of the room. I have to say that this report is co-authored with my colleague Gennaro Zesa. On the prospects, on the current state and the prospects of the US economy. As a way of introduction, let me repeat myself. People who have been here in the previous years have already seen this slide. So in recent reports, we have identified 3 main structural problems to a robust and sustainable recovery of the US economy. And these are high income inequality, weak net export demand, and fiscal conservatism that has been prevalent in Washington over the last decade. And the reason for that, if you think about it from, let's say, demand-led Keynesian model, is that if you have a weak net export demand and at the same time there is restrictive fiscal policy, then economic growth becomes dependent on rising private borrowing, and therefore an increase in the debt-to-income ratio of the private sector. And on top of that, if you have rising income inequality, this increase of the debt-to-income ratio falls unevenly on households at the bottom of the distribution. And this kind of process is facilitated, needs to be facilitated by asset inflation. So as Randall was writing 20 years ago, the Main Street is at the mercy of the Wall Street to an unusual extent. So I think that thinking along this axis is a better explanation of what brought us to the crisis of 2007, why the recovery since 2009 has been so weak, and also I think it provides a more coherent explanation about the reasons behind secular stagnation, more coherent than an exogenous supply side explanation a la Robert Gordon, or the zero lower bound explanations that have been provided by Summers or Krugman. Actually, people have suddenly stopped talking about the zero lower bounds after we had negative interest rates, and this didn't seem to do it. Okay, so let me talk a little bit about how we build our projections. So we always have a baseline scenario. For building this baseline scenario, a tactic that we often follow is to build it on top of the budget and economic outlook that the CBO publishes every year. So usually this publication comes out in January this year. The CBO delayed its publication. It was only published last week, and we built out our baseline scenario based on the budget and economic outlook of the CBO that was published last June. So the CBO makes some projections on the growth rate of the US economy and the fiscal stance of the US economy under current law. And we use this, last June's projections of the CBO, although, what used to be current law last June is not current law anymore. But it's an interesting exercise because building this baseline scenario then allows us to evaluate what is the contribution of the new tax law, the new budget agreements to the growth and the prospects of the US economy. So to build this baseline, we make assumptions which are as neutral as possible. For example, we assume that the US trading partners grow as projected by the World Economic Outlook of the IMF, that the Fed rate moves according to the median projections of the FOMC, and so on. I'm not going to present the results of our baseline scenario. It's kind of a business as usual scenario. The economy grows, continues to grow along this slow recovery path of the last 9 years. One interesting thing about this baseline scenario is that there are tendencies of the current account deficit to increase, even along this slow recovery path. Okay, so one of the first major change in U.S. fiscal policy in the last month was the new tax law that was voted and was signed last December, the so-called Tax Cuts and Jobs Act. As we can see here, according to this new law, there is a decrease in tax revenue around $2 trillion. There is an increase in tax revenue because of the change in offshore taxation of $300 billion. So the overall change, estimated changes in revenues are around 1.65 trillion. And then there is a reduction in direct spending of the government around $200 billion. This reduction is related mostly to the repeal of the individual mandate of the Affordable Care Act. Actually, this is an interesting point because we had the new tax law, and we also had the recent budget agreements. So we had a huge fiscal expansions over the last few months, and the only expenditure cut that took place was the subsidies for the very poor of the United States to buy insurance. So this was the only expenditure cut, and probably this says a lot about the US political system. Anyway, the overall impact of deficit, as it is estimated by the CBO, is going to be around $1.5 trillion. And this is, again, this is a CBO projection, and this shows the distributional effect of the new tax law. I hope you can see these numbers. So a minus sign here means that the households in this income bracket are better off. A positive sign means that the households in this income bracket are worse off. So we can see that the very, very poor households, because of the repeal of the individual mandate, they are worse off since day one of the introduction of the new law. And we see that, you know, as time goes by and the provisions of the law phase out, only the households at the very top of the distribution remain with a negative sign. So only the rich households will be better off after 10 years based on the new law. Anyway, this is obviously an important fiscal boost because it will obviously increase income inequality. It will not have the positive effect that it could have if this was not the case, but for sure it will have some positive impact on consumption. What about investment? When this new law was discussed in Congress, the supporters of the law emphasized the major boost that it would provide to investment. Now, from an economic theory point of view, higher profitability, because of the reduction in the corporate tax rate, boost investment for two reasons. One reason is that it provides internal funds for new investment, and the other reason is because firms anchor their expectations about future profitability, which drive their investment decisions on current profitability. Therefore, such a decrease in the tax rate boosts firms' expectations about future profitability. However, a central macroeconomic highlight fact of the last decade has been that the gradual decoupling of the investment decisions of the firms from the cash flows. Instead, it's increasingly evident that firms use this, they increase the profits to buy back their shares or to pay back dividends to their shareholders. So an example of how increasing internal funds may or may not affect investment is provided by the recent tax holiday that was provided by the Bush administration in 2004 through the American Jobs Creation Act. This was a tax holiday so US firms could repatriate their profits. And there have been extensive studies that show that they had a negligible to nil effect on investment. Instead, these studies have shown that the firms that use this tax holiday to repatriate their funds, they use this money to, again, give dividends to their shareholders and buy back their shares. Two more things about the change in the U.S. In the corporate tax system. The tax system moves towards a territorial a system which it provides essentially a disincentive for the U.S. firms to increase their domestic investment. So this is another reason why we don't expect to see a big increase in investment because of that. And also, there is also extensive academic research that shows that corporate tax cuts in the United States are imitated by other major economies. So, and therefore, the positive effects that one can expect that a corporate tax cut might have in the United States do not really materialize because the trading partners just follow and cut their tax rates as well. So overall, one would expect that, yes, the new tax law would have a positive macroeconomic effect, but not that big, because it will have a small effect on consumption, but because it will lead to an increase in income inequality, the effect is not as big as it could be, and it will have a negligible impact on investment. And this is basically what we get when we, fit the numbers into our model, and we try to produce an estimate. This is obviously a very crude estimate, since people still try to digest. It's a gigantic 500 pages law, so even the CBO or other agencies have not managed to produce detailed estimates of the impact yet. But anyway, a crude estimate from our model shows that we will have a positive impact around 0.15% of GDP, of increase in the growth rate of GDP in 2018, around 0.40% in 2018, and this will fall towards zero in the rest of the projection period. Overall, the new tax law will provide a boost of around 1% of GDP in these first 4 years of its enactment. And this will be accompanied by an increase in the government deficit in the medium run of around 0.9% of GDP, and also an increase in the current account deficit of around 0.6% of GDP. So, as I explained, I think that the tax cuts were given to people and to corporations that did not really need them. So I think there were more efficient ways to utilize, let's say, this change in the fiscal deficit of the government. One would be to use this change in fiscal deficit to redistribute income. We have been witnessing a huge increase in income inequality over the last 30 years. So this kind of big fiscal exercise could be used to reverse this trend. Another thing that we've been talking about a lot over the last few years, and we have written a lot, and also has been discussed by President Trump and also by the Democrats in Congress, would be to use this money towards a public infrastructure plan. But what we're talking about here is a plan that will be carried out by the government. The current administration has been talking about that it will commit $200 billion towards such a plan, and then the private sector will leverage this money up to $1.5 trillion. But it's really hard to see how this will happen. So this is this is a scenario where we use the increase in the fiscal deficit due to the new tax law. We use these numbers, and we say, okay, what would happen if this increase will take place if this increase would be channeled towards an increase in public infrastructure spending. And we see here that the overall fiscal boost to the GDP is double compared to the new tax law. So if if we add the differences in the growth rates here, such a plan would provide a boost of around 2% of GDP in the next 4 years. And because the growth rate would be higher, also the increase in the fiscal deficit as a percent of GDP would be low. So the other major change in the legislation over the last month was the Bipartisan Budget Act of 2018 and the Consolidation Appropriation Act, what people have been referring to as the Omnibus Bill, that were voted in February and March respectively. After 7 years of austerity that was enacted in 2011 with a Budget Constraint Act, this new piece of legislation, they raised the caps on discretionary spending for 2018 and 2019 by $143 and 153 billion. So this is a very significant reversal on fiscal policy next to the new tax law. So we ran another scenario and we tried to evaluate what does this mean for the US economy. And what we see here is that in 2018, this increase in fiscal spending will have a significant effect on the growth rate. So in 2018, we see that compared to the baseline, the increase in fiscal spending by $143 billion will increase the growth rate of GDP by 1% above the baseline. And this, because the new laws do not, fiscal spending remains stable, this growth effects will slowly diminish towards the end of the projection period. So overall, just to summarize the total effect of the new tax law and the new budget bills will be an increase in the growth rate around 1% of GDP both in 2018 and in 2019. Okay, so last scenario. So in this report we also updated the last year projections. What would happen if there was a correction in the stock market that was accompanied by a second round of the leveraging of the private sector, like it happened in 2007. So as we argued last year, looking at the stock market, one cannot but notice that it is highly overvalued. So if one looks at the ratio of market capitalization to GDP or to net operating surplus, we can see that this is at its highest point in history. If we look at the price earnings ratio, last year this was below the levels of October 1929. During 2017, the P ratio surpassed the levels of 1929, and it's only lower compared to the late 90s. So, and this situation is coupled with elevated indebtedness of households and firms. Households are not as indebted as they were in 2007, but still their indebtedness are much higher compared to any other previous time period. The firm's debt to GDP ratio is higher than any other period in the past. Is also coupled with an increase in the size of the shadow banking sector, and increasing interest rate, and unwinding of the QE. The QE has now become the QT. So in scenario 4, we run a simulation where the stock market falls in the second half of 2018 and the first half of 2019, and then stabilizes for the rest of the projection period. The S&P 500 index falls to around 1800 by the second quarter of 2018, which is still above its pre-crisis levels in 2007, in 2000 and 2007. And there is a second round of deleveraging lasting from the end of 2017 to the end of the projection period. So this is just, to get an idea what such a scenario would mean for the US economy. And based on our model, we get, a very negative impact on the growth rate, which is around 2.5 to 3% of GDP, both in 2019 and 2020, and then around 2% of GDP in 2021. Okay, I have a slide for tariffs, which maybe I will refer to in the Q&A because Randy told me to wrap up. So just to conclude, in the short run, we believe that the fiscal expansion will have some significant positive effects on the growth rate of the US economy. At the same time, inequality will definitely increase as we saw, and the trade policy is unlikely to solve the weak net export demand problem that I referred to before. I think there is also a high likelihood that sooner or later we will reverse to fiscal orthodoxy. Already Republican members of the Congress, they're talking about cutting the entitlements to decrease the government deficit, and as I mentioned, recovery is threatened by the financial fragility in the markets. Thank you very much.
Okay, so we have 20 minutes, and I think I'll take one round of questions, so you guys jot down the ones you're interested in, and then we'll do another one. Hopefully we can get several. Questions? Okay.
Phil, you raised the question as to why we're not seeing enough investment, and I wonder to what extent that relates to what Lakshman was saying about lower secular growth. In other words, is not investment a function of how much capacity utilization we have, and with lower growth, you just simply don't need as much investment as you might otherwise need. We shouldn't perhaps be surprised that investment is up.
Okay, over there, yeah. Anybody over here?
Hello? The acceleration of core CPI, Phil, I wonder how much that has to do with the recent performance in Suttle.
Question would be directed towards Lakshman. If we're currently in a growth cycle downturn, is it true that there are two potential next steps, a recession or a growth cycle upturn? And if that is the case, do you currently see leaning one way, one scenario winning out versus the other?
Okay, and last one on this round. One more.
QE was a massive intervention in markets that propped up asset prices, and the idea was that once people felt more secure, both the corporations and captains of industry and the consumer, that animal spirits would kick in and they would all work together to invest and rebuild the economy. That doesn't seem to have been the scenario, more of one of financial engineering rather than capital expenditure. So my question would be if that massive intervention did not invite animal spirits, what would be an alternative policy solution?
Okay, so we'll get some answers to that. Or just go down the road.
Okay. No thinking. So, why, the first question, I think, was maybe one of the reasons there's kind of a missing, investment has been missing is because of low growth. And I think that that makes sense empirically when we look at the contributing factors to productivity growth in retrospect. One of the big ones is the contribution of capital intensity. That's the ratio of capital to hours worked. And since 2010, I don't have the very latest numbers, but since 2010, this is good through a few quarters ago, that had gone negative. And that hasn't happened on such a sustained basis in the entire post-World War II period. So there is, I believe, something there empirically when you look back at what's going on with productivity growth. Although, to be fair, it's really hard to look forward and know exactly what's going to drive productivity growth. We do see this in the back. That's definitely, I would say, a contender, something to think about. And when we look at, just anecdotally, where'd the money go, it seems to go into dividends or stock buybacks or other places. And literally, when you ask executives, what are you going to do, they tell you that. So pick your, pick which piece you want to listen to. Maybe you want to continue on that question?
Well, I mean, there's two issues here I'd like to separate: the inflation discussion and and the dollar. I think it's quite important. We didn't quite talk about tariffs. You could argue that's the big elephant in the room or whatever on this in the current cyclical environment. Because first of all, we're not sure if they're going to be implemented, and then we don't have a lot of recent experience of how that kind of protectionist game plays out. But the way I think about the US is that we are headed for an upswing in core inflation for domestic reasons, and we would normally see that constrained by a rise in the dollar. So we'd import some help from abroad in terms of keeping on top of inflation, and the fact that's not happening probably makes me more worried about the core inflation uptick that we're seeing and its persistence, and then it's spread into a more general inflation psychology. Because I think at the end of the day, we're going to get a serious inflation problem developing, not because of slack or because of this, that and the other. It's because of inflation expectations changing. They are currently anchored. I hate that phrase, but I'm going to use it. They are currently anchored. And it's got nothing to do with central bank prowess and track record or anything. It's just because these things are hugely inertial. And at some point, they're going to become unanchored, and that's going to be a problem. On the issue of Charlie's question, the other question about the CapEx and QE, I'll link them together if I may. I think the stunning feature of this expansion is how conservative corporations have been, given everything that's kind of been thrown at them. And to me, there are two competing hypotheses here, or stories, narratives, let's call them. It depends a bit on your political view and all that. One is what you might call the Reinhard Rogoff thesis, which is after a deep financial crisis, it leaves very, very dramatic scars. And however much you push businesses to take more risk, they won't. And that's precisely what we've lived through, and it's sort of just been you take your medicine type of story. I think the other is that, and I confess I probably should run out of here quickly once I've said this, but I confess I've got some sympathy for, which is that there was overkill on regulation in the aftermath of the financial crisis. Understandable, but it happened, and what it meant was that we added to the fiscal drag on the first 5 years of the expansion, and these two things that have collectively been called headwinds. There's a lot of woolliness and vagueness about what these headwinds were, but these were the two factors. And the fiscal side and the regulatory side is now changing. And it's sort of, oh my God, you did the stupid thing in the first 5 years, and now you're going to do the stupid thing in the next 5 years. Which kind of, in a sense, doesn't necessarily give you a good investment environment, because the business is going to be even more scared. But it certainly increases your risk of cyclical and asset market instability.
No, I'm sorry, I didn't grab one of those earlier questions. I just went with one. I don't know if you want to keep going.
Go ahead and do it.
Okay, all right. Since we went to inflation, I would just clarify that, there's a cyclical upturn in inflation in the leading indicators of inflation, the cyclical leading indicators. It does qualify on all the basic objective kind of measures that we would look at. It's not super pronounced, it's just cyclical. And I think the bigger point is it's not a removal of structural lowflation. And even on the cyclical upturn, there's some indication, given the cycles in inflation around the world, and in particular in the emerging markets, that we're going to get some muting of our inflation cycle upturn by lower inflation pressures in emerging markets. So I wouldn't really expect it to go running away just in the basis of the inflation cycle, although there are a lot of other factors at play. And then there was a question about recession. How does this end? How does the slowdown end? So you're right. It is, I think, to keep it simple, binary. It could be a growth rate cycle downturn that ends in a so-called soft landing of some sort, or it doesn't. And the longer the slowdown continues, this is an important point, the longer a slowdown continues, or the closer the growth rate starts without an upturn showing up in the forward drivers of the cycle, a window of vulnerability begins to open up, in our view. And during that time, almost any negative shock can be recessionary. So before that time, before you're vulnerable, you can see shocks, and we can look around and say, "Boy, that was a bad one. That was a bad one. Why didn't that do more?" And in our mind, it kind of very much depends on where we are in the cycle and where we're likely to be very short near term, which determines, you know, which of these shocks ends up being recessionary or not. Which is why I ended the talk about the timing of some of these big policy moves, and we had shared some concerns about what happens when you, for example, go from QE to QT globally. And if you think about it, in the cycles in the post-financial crisis period, it's not that we didn't try to normalize, right? Like we got the exit path. There were different kind of stories to it. When things slowed down, you had to take your foot off the brake. And so here, we're going into our fourth growth rate cycle downturn in our view, and we're putting our foot on the brake. And we're doing it in a somewhat more advanced way than we did in the earlier cycles. So some concern around that, I would say. We'll know really if the forward indicators really deteriorate much more sharply. Today, that is not the forecast. There's no recession or window of vulnerability this moment.
About investment, I think that you're right. Yes. I mean, if economists know very little about growth, we know even less about investment. But I think I think you're right that lower demand means lower investment. And I think that's one of the big explanations why investment has been so weak over the last years. And I mean, there can be other explanations as well. The stagnation of wages doesn't provide any incentive for firms to innovate and adopt more capital-intensive techniques. So that's another reason why this index is negative, and that's also probably an explanation for why investment has been so weak.
And just adding to that point in a way, if you think about it, so you've heard about the so-called zombie companies, the idea that something that should have maybe stopped or been absorbed was kept alive, and to a degree, you know, there may be some of that going on, excess capacity here or abroad, or even in the reaction to the financial crisis, all the capacity that was created in the emerging markets in China in particular, a lot of stuff. That capacity that is there, and if demand is subdued for whatever reason, it's, you know, as a business manager, why add capacity? It's unclear.
Okay, we can do a very quick round. I think any questions from the backs of the audience? Are there any back there? Okay, 1, 2, and there's one way back there.
I have a question about the business cycle in general. My background is more engineering, and I hear frequently more from like the Robert Schillers of the world saying that we're late in the cycle and we should be, you know, our antenna should go up and be aware of that and be concerned about that. From an engineering perspective, they say the average cycle is 3 years to 9 years, and we're getting close to the end, so beware. From an engineering perspective, that wide range is like the bridge we came over. If I'm the engineer saying to the engineer in Hudson County, well, I'm going to build in between a 30% safety factor or a 100% safety factor. 30%, that bridge will very likely fail in the next 5 years. The 100%, it probably won't fail in the next 100. So my question is, why the focus on this 3 to 10 year, such a wide span? And why is it talked about so much? And the other same topic, I can ask 2 questions. Is we talked about business cycle, and I want to focus on the negative end of the cycle, when the, you know, recessionary, whether it's weak or, you know, severe recession. And it almost sounds like it's like, this is inevitable, it's like Voldemort coming back, right? Or is it something that's really policy mistakes, or you know, not intended, but Jan did an excellent job summarizing in layman's terms policy mistakes. So it is the policy mistakes that causes the business downturn, or is it this, you
just can't avoid it. Baltimore's coming back.
Okay, number two.
These were very impressive presentations. However, I found that 3 graphs were missing. One graph was the Dow Jones curve, why it was at record highs with no capital investment. The second was share buybacks, and especially in the period of 2014, 15, and 16. And the third was the productivity curve. All 3 related, of course, because in fact, whatever the respected Professor Rogov says, these firms were not stashing up cash. They were spending it as if there is no tomorrow. They were burning it in share buybacks, doing nothing about productivity. So how is the Dow explained? Is the problem really deeply structured at the end of the day? Financialization has created lots of sources of profitability for short-term investment, and that's the real problem. The question.
Okay, and the last one is way in the back.
We're just getting some, hopefully, no one really talked about this, but credit creation and loan demand, if we can just get some perspective there of how loans, most expansions accompany growth in loans, and most contractions, you have credit contracting and loan demand going backwards. So if there's any thoughts or perspectives there.
Started before.
How much time do I have?
90 seconds.
Okay. The downturn policy mistakes are inevitable. I think downturns are inevitable. Capitalism is full of contradictions, and at the end you will have a downturn. But I think policy choices determine how severe will be these downturns. And I think that the severity of the downturn in 2007 was had to do a lot with wrong policy choices in the decades before that. And I tried to highlight this in my presentation. Economics is not like engineering, so it's hard for people to be sure about the length of the recovery. Right now, this current recovery is now the second longest recovery in the post-war history, and it's like a few quarters before becoming the first one.
30 seconds.
30 seconds, okay. I referred, related to Emilios Avoulias' comment, I referred to some of the stuff in my presentation. I didn't have graphs. Yes, it has to do a lot. I mean, these whole structural problems that I refer to are related with the financialization of the economy and to the incentives that firms now have to, channel their profits towards short-run financial investment instead of actual investment.
Okay.
Well, I'll leave Lakshman to talk about the business cycle because he's the expert, but I would observe that Australia has not had a recession since the early 1980s, so they a well-run economy doesn't have to have them. Plenty of other things involved there. On the credit, well, actually, I'm going to kind of pull the last two questions together because I think going back to one of my earlier answers, I think this cycle will be characterised as one of just extreme conservatism on risk-taking by those borrowing and lending money. So credit creation has been unusually weak through this expansion, and there's a big debate as to whether it's a demand story or a supply story. In my mind, there's no, it's clear it's a supply story. There was much more conservatism in credit creation especially by banks, and not just in the United States, but across the industrial world. Less so, obviously, in the EM world. But I think it comes back to this idea that if you're going to lose your job in the modern economy, if you're a business manager, a CFO, let's say, or a treasurer, you're probably going to lose it because you took a reckless bet on, buying a machine. You're almost certainly not going to lose it because you used spare cash to return to shareholders and boost the stock price and do all these other supposedly good things. So I think when so many companies had financial near-death experiences in the 08-09 downturn, an inevitable result was that you're going to see this very conservative behaviour on the part of businesses. Of course, the corollary of this is we are fast moving to a world where capitalism is disappearing. I mean that in the sense that the public company as a concept, which I happen to think of as is what capitalism is all about, is just kind of eroding in this country. Companies are just sort of melting away like the polar cap.
Thank you. On business cycles, late cycle and that, I share the observation Australia, pretty well run policy and some luck, and you can have very long expansions. So when in China 89 was the last recession, a little more managed. I appreciate the question because we avoid that late cycle description. Because who knows? You have to watch, to the earlier point, does this growth rate cycle slow down, end in a soft landing, or does it end with a window of vulnerability that's recessionary? Are they inevitable like Voldemort? I'm in the prisoner of Azkaban now, with my daughter who's 10. So this is a big topic, and yes, they are inevitable. You have, recessions are it's the Achilles heel of capitalism, they're part and parcel of free market economies. As far as we could tell, and my mentor Jeffrey Moore started looking at business cycles outside of the US in '79, and since then, we're covering 22 economies and looking at managed economies where you wouldn't expect cycles and you don't see them the same way. And the long and short of it is over space and time, such as we have it on this planet. Yes, in an economy dominated by free market activity, you're going to get recessions. And so therefore, it also is an Armageddon. It's not the end of the world, because we're still here. And we do manage through these things. There you have the policy, let's focus on central banks. They're in there, they're trying to do something and trying to push back against this. We have automatic stabilizers in the system, abundant and other things, that social safety nets will take the edge off of some of these cycles. But if your policy is an interest rate, which works with long and variable lags, and you're not that clear on where a cycle turn is, you could be, to your engineering background, actually accentuating the problem if you get the timing wrong. And so I think that's a real big issue, the timing, and that's why I get back to the timing of whatever your strategy is for a business or for a country, when are you going to pull the trigger or lay off?
Okay, on the optimistic